Thanks for joining us today on Market Call. I'm Morella Fernandez. Christine Poole with us on the show. She's co-chief investment officer at Davis Rea. She'll take your questions on North American large caps. Here's how to reach us today. 1-855-326-6266 if you want to call in. You can also email your questions to marketcall@bnnbloomberg.ca. Christine, good to see you.
Nice to be here, Morella.
Let's talk about North American markets dragging down for a second day, starting in the red after closing down yesterday. Is this big tech valuation sentiment, you think, still pushing things along?
I do think so, because as we know, that's the sector that has led the market and brought up the general indices. And so I'm not, and the markets have been very strong year to date. We had the pullback in April, and they've been up very strongly since then. And so I think it's just kind of a natural, some of the valuations in some of the names and the very momentum-driven names got ahead of themselves, arguably, and we're just getting a bit of a pullback.
What about earnings? What have you seen so far as whether or not tech is delivering on promises?
Well, I do think the tech earnings are coming through. We had the big Mag 7 numbers companies report. I don't think Tesla, I'm not sure if
NVIDIA hasn't reported.
And NVIDIA hasn't. Yes. But they all came through with their numbers, but obviously they also increased their CapEx for this year and next year. And so that was kind of, they're seeing very strong demand. And we all know there's this debate out there is, when are companies going to see the payback on all this investment? And so there's that question mark. But generally speaking, if you look at the S&P 500 companies, and obviously these large cap names dominate in those earnings numbers, the earnings are coming in better than expected. For the third quarter, they're expected to be up 14%, and then up again in the fourth quarter. And for the year as a whole, earnings are expected to be up 12% and 14% next year. So the consensus is that we're not going into recession, because typically if there is a recession, a slowdown in the economy, profit growth gets hit, and you actually have negative earnings growth, and that's not what we're seeing right now.
What about the other sectors? If tech is delivering, what about everyone else?
I actually think that the other groups have been okay. We know that the impact of tariffs have not been fully felt yet in the economy because they've been delayed in implementing them. And as well, some of the companies have been good at mitigating some of the tariff impacts. We know companies serving the lower end household, lower end consumer, they are seeing, we're seeing that's a weak household. Spending is not as good. But generally speaking, the industrial companies and earnings, I think, have come through. And, when you think of the data center growth and all the hyperscalers building data centers, that's actually providing growth for a lot of companies that are servicing that area in terms of, obviously components, services, semiconductors is an obvious one, but power generation, gas turbines, which is an industrial product, even utilities have done relatively well because you need power to power these data centers.
Okay. Let's talk some more as the show goes through. We're going to be back with Christine Poole of Davis Rea. She's taking your questions today on North American large caps. Here's how to reach us. Back in a moment. Welcome back. We're going to start with an email from Dawn, who says, I saw the CEO of Allied Property REIT on BNN 6 weeks ago. She assured viewers that the dividend is safe. What's happened to prompt the recent sell-off? Should I stay or should I get out? Let's pull up the line chart for Allied and have a look at what has happened here. Anything specific that would trigger a sell-off?
Well, I believe the company reported their numbers last week, and occupancy, they were targeting to get to a 90% occupancy, I think, by the end of the year, and that's been pushed out. They're finding that it's around the mid-80s right now, so they're pushing that out. The company is very leveraged. There's a lot of debt on its balance sheet, and with the rise in interest rates, well, interest rates have been higher, so their refinancing costs have gone up as well. And so I think the viewer said that the CEO had said that they were not going to cut the distribution, and there was, I think, a comment made by management that they would consider a distribution cut, which would, obviously save on their cash flow. I think that's what caused the stock to drop again. And based on some of the reports I've read, some of the analysts on the street are actually kind of baking in almost a 50% cut for next year, even though that hasn't been announced. But I think just the fact that they may cut the distribution. I think the distribution yield is over 10% right now.
I think it's closer to 13, 12,
13,
8, 5.
yeah. And so once it gets above that 10%, that means that there's some doubt about whether this distribution should be kept at the current level. So I think that I think for Allied, it's going to take a long time for the office market to recover, especially for some of their areas that they're in. So if you're looking for kind of an income stock, perhaps you have to move on and find something else that's more sustainable.
Okay. Let's go to our first caller then. Elliot is in Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. MDA Space loses one contract and goes to 32 from 48. Now there seems to be some whisper on the street or somebody perhaps trying to short it, and it's dropped to 23. I really don't know how to handicap the political risk if American companies decide to go with American suppliers and boycott Canada. Please, is this a lot of noise? Is it realistic? Would you buy MDA at 23? Thank you.
Okay, thank you for the question. Yeah, that EchoStar contract loss hit it, and most people expected a recovery after that. That hasn't happened.
No, I think the caller is right. There's speculation that they may lose the Globostar contract because SpaceX, which is Elon Musk's company, is consolidating, doing M&A, and perhaps they might be either buying Globostar or taking some of its business. So there isn't a lot of visibility on what MDA's outlook is going to be. Obviously, based on the stock price reaction, that was a very big surprise for the street. And so I don't think, we don't own MDA, and I don't think you should step into the stock until I think the company's going to report in the next week or two. So they might provide more of an update and provide more clarity on what they're seeing going forward.
Okay, so you'd wait for that before making any decisions.
Correct.
Got her. Let's go to Rick. Rick's on the line. He's in Vancouver, BC. Hi, Rick.
Oh, hi. Hi, Christine. I bought Zoetis a couple of years ago, and it's down over 20% since I bought it. They got hammered last week when they cut their guidance going forward. So would you recommend that I continue to hold, or should I sell? Thank you very much, and have a great day.
So they do animal health medicines or vets kind of thing?
Yeah, animal health care as well as cattle, livestock. So, cows, pigs as well. But yeah, they do. And the call, Rick is right. They reported their earnings last week. They did cut guidance, and it's really centered on Librela, which is their pain management drug that they launched about a year ago for dogs, and they also have a version for cats. And, the company believes that this is kind of a really big blockbuster drug. It's addressing a need that's underserved. But there has been some, observations by vets or pet owners that when their dog has been given this drug, that it actually causes some ill effects and in some cases even death. But usually you don't give this drug to a dog unless they're older because they have osteoarthritic pain and there's pre-existing conditions. So their studies have shown that that is not the case. That's not a side effect, and they've been given the okay by regulatory authorities to continue marketing this drug. But it is causing, slower uptake in the drug, and as well in terms of just pet visitations, like going to the veterinary office. That has slowed, I think, because the economy is slowing. Households have less discretionary spending. So perhaps they're not taking their dogs or cats as often to the vet. And so they're finding that is starting to impact some of, their prescription demand for various drugs. But, we continue to hold Zoetis. I think it's the leading player in that space. It was spun out from Pfizer about 15 or 20 years ago. It provides very necessary drugs for pets in general. And I think pet population is growing as well. I know we had to spike up during COVID, and there was a fear that, everyone bring their pets to the shelter and growth would slow, abandoned pets. And that hasn't really happened. And in fact, I think, some of the younger generations are having pets instead of children. So I do think that they provide a very necessary need. And the valuation is at a PE basis now is at a very much discounted from historical. So it's been reflected in the share price. So I think it's going to take some time. They are launching new drugs as well. So I would keep holding it.
Okay. I hope that helps them out. Let's go to Jim in Kingston, Ontario with a question. Hi, Jim.
Hello. I'm looking at Goeasy. I've been following it for quite a while. but it was over $210 a couple of months ago, and now it's below 130. Is it a buy now, or are the red lights flashing and it's just saying stay away from it?
Okay, so good question, Goeasy. Lender, there's been some question marks about sort of credit and bad loans or customers not paying on time. What's your take on Goeasy?
Yeah, it's not a name we own. And I think, given the drop in the share price, I think when they reported last week, there was elevated loan losses. So, which is never a good thing for a financial institution. And I think their client base tends to be lower income, individuals who may not necessarily qualify for a loan with the Schedule A banks. And we know the lower income households are suffering. So whenever there's credit problems, it's very hard to see, what's going to unfold in the future. So from my perspective, we've stuck with the large Canadian banks. They're much more diversified. And so I would not be stepping into Goeasy.
Okay. We're going to take a quick break. We will get to more of your phone calls with Christine Poole of Davis Rea when we come back. Stay tuned. Welcome back, and thanks for joining us. Let's go to Chris. He's on the line in Delta, BC, with a question. Hi, Chris.
Oh, hello, Morella and Christine. It's great to see you back on the show. I always look forward to you coming on. Hope all is well with the big merger of the two companies. My question is on Thermo Fisher Scientific. I know it's been I believe, a long-term pick of yours in that life sciences, healthcare, big field. And I've owned that as well as a similar company, Danaher. And I've kind of come to the conclusion that I'd like to merge those two positions into Thermo Fisher going forward. And I'd just like to get your thoughts on the company today. Thank you so much.
Can you tell me a bit about Danaher before we get there?
They're kind of in the same space, like providing kind of, healthcare.
Life sciences,
exactly.
supplies,
exactly.
Okay.
And I would think that Danaher probably trades at a slightly higher valuation. So we continue to own Thermo Fisher, and we like that name. As Chris said, it does provide it's like kind of the picks and shovels to the healthcare industry. They provide all services, testing. They can help a pharmaceutical company bring a drug in from the very beginning of development to clinical trials to actually producing the drug. So the healthcare companies, pharmaceutical companies, governments, labs, they're all clients of Thermo Fisher. And so Thermo actually experienced quite a bit of growth during COVID. And then they had to kind of work through, the top line had to normalize. And then at the same time, they saw weakness in China. And when interest rates started going up, there was, companies, and especially for the biotech sector, there was, I guess, funding slowed because of higher interest rates. People were waiting to see how that was going to play out. So the growth for Thermo slowed a bit, stock pulled back. But I think now going forward, the past few quarters, the CEO is, they still believe this industry is going to grow whatever 5 to 7%, and they're going to grow slightly higher than that. They will do M&A as well. CEO is very well respected, and we do think healthcare as an industry is attractive longer term because of demographics. And so for Thermo, they just provide all their services and tools to all the whole healthcare industry. So we think it's a good core holding in that area.
Let me put the overlay of the Donald Trump administration, which has been cutting research and development funding with the universities, that kind of thing. Is there any concern around that?
Well, I think that they're finding that, we know that for pharmaceutical companies, originally they were saying he was going to put tariffs on their drug prices. But if you kind of make a commitment to
make a deal
and build a plant, and so many companies have stepped up and done that. And the plant may be built like years from now, but that's in the plan, and he seems to be satisfied with that. And so, yes, for the cutbacks in maybe you say R&D work in the universities, that might have a slight impact, but they're very diversified in terms of their client base, and geographically they're very diversified as well. So I think that's manageable.
Okay, let's go to Tony on the line in Toronto with a question. Hi, Tony.
Hi there. Christine, your thoughts on UnitedHealth? Do you own it, and would you step in at these levels? Thanks.
Okay, thank you for the question. UnitedHealth.
Yeah, so no, we don't own UnitedHealth, and I'm not looking to add it to our client portfolios. Like, as we know, it's a PBM, pharmacy benefits manager. The whole sector has gone through some issues in terms of medical cost trends, meaning that the premiums they're charging are not covering
the actual costs. Yes.
The actual costs, or there's more patients taking of these various services. They brought back their old CEO, I think about maybe mid-year or a few quarters ago, and he's very well respected. He grew the company historically, so he's kind of resetting, I guess, the expectations. But they're going to reprice next year, so eventually, hopefully, that it fixes itself. But I still think that once again, the Trump administration is very focused on medical costs and pricing, et cetera. So this industry always seems to be under pressure with that. And I'm just kind of on the sidelines for the whole industry, the whole BBM industry.
All right, good to know. Let's go back to the phone lines then. We have Henry on the line in Vaughan, Ontario. Hi, Henry.
Hi there. It seems to me that we're undergoing a correction in the high-tech sector, which is pretty overvaluated. And I'm looking at Taiwan Semiconductor. At what price would you consider buying Taiwan Semiconductor? Thank you.
Thanks for the question.
Okay.
Let's pull up the chart for Taiwan. I haven't looked at Taiwan to compare to some of the others, so let's do that. Okay, it's down 3.6 today. It's at 278.92, down a little bit. What do you think?
Well, I mean, we all know Taiwan Semiconductor has really benefited with this whole build-out of data centers and AI investment. Typically, we don't kind of invest in the semiconductor space. It tends to be very cyclical, but now it seems to be viewed as a growth sector. And so we've seen the valuations on a lot of these names go up. Taiwan Semi, actually, they do the manufacturing for a lot of semiconductor companies, so they're kind of the leader in that space. So I guess if you want exposure, it's probably arguably one of the better investments. But I still feel that the valuations are quite high. And we don't know the sustainability of how long this growth can continue for. And so we're not ready to step into that space. And unfortunately, I can't give Henry a specific price for entry because it's not a name that we're going to, I don't think, add to our portfolios.
Okay. Let's move on then to Nick, who's in Toronto with a question. Hi, Nick.
Hi. The market was expecting earnings of like $10 a share. They kind of disappointed on their last earnings release and said full year earnings would only be about $8 to $8.50 per share. But even at that price, it's only trading at about 8 times. And even if it falls to like low $6 range, it would only be trading at 10 times earnings. For me, I find this pretty cheap. Do you think it's a good buy here? Thanks very much.
So this is a sort of digital payment?
Yeah, it's a payment processing company, and they have, I don't know if you've seen those Clover terminals at merchants, like it's point of sale machines, and so that's their product as well. And I think like they had a new CEO come in I think mid-year, and he kind of reviewed the business, and he brought down the guidance, and there seemed to be some kind of, I guess, I didn't actually listen to the conference call, but that perhaps the old CEO was kind of bringing forward some demand, some numbers to,
make it seem better than it was.
Yeah, to kind of boost or sustain the growth rate. So the question now is, how sustainable is this growth rate? And so I think it's still uncertain as to what their growth will be in the future, a normalized growth rate, which is why maybe the stock has come back so much. Because in the past, it was a kind of a regular, used to grow their numbers double digit, kind of a very sustainable track record. And then this happened, which is what caused the stock to pull back. So I think until you get more clarity from the new CEO and what he sets his expectations are going forward, I would not enter this name.
Okay. We're going to take a quick break. We will have a look at Christine's past picks when we come back. Time now to have a look at past picks from Christine. October 21st of last year are the time period when she picked these picks. We're going to start with CGI, GIBA on the TSX, and at the time it was 158.45. It's down to 119.64, so 24% drop return. and total return the same. This is a computer sort of technology information consulting company.
Yeah.
What's been going on with CGI?
Yeah, it's a consulting, integration and consulting company based out of Montreal. We've owned CGI for many years, like probably since like 2009, and we continue to like it. Yes, this whole sector that they're in, there's been an overhang in terms of, is AI, when companies implement that, is that going to impact demand for their services? The company doesn't think so. Maybe there's a temporary lull as companies reassess, but if they want to integrate AI into their operations, they're going to need assistance. And so CGI has two businesses. There's the managed services, which is kind of outsourcing, and there's a systems consulting and integration, which is just your typical consulting business.
Okay.
So managed services is about 55% of the revenues. And so these are like call centers, like long-term contracts, and CGI is implementing AI into their own internal processes to make them more efficient. And so this will be beneficial for that service as well. In terms of their consulting side, yes, there's been a kind of a slower demand uptick. It could be a function that the economy is a bit slower, corporations are uncertain, maybe they're allocating a bit more capital to AI type investments. But I think in the end, like CGI has the expertise into that into the company's if the company wants to implement AI-enabled processes into their own processes, they're going to need some assistance. And with governments cutting back, wanting to cut costs, they're probably going to there's going to be a demand for their services as well. But nonetheless, and they're still able to grow their backlog. They reported a few days ago, backlog is up. And this company will grow through M&A, and they're saying now, their balance sheet's very strong. The past few years, valuations were too high. They've come back quite a bit now. And so I think in terms of M&A activity, we're going to see a pickup. And the valuation is, they're trading at about a PE of forward earnings of less than 14 times. So it's at a very discounted valuation.
Is
so
this something you've held on to?
Yes, and I would be buying it here.
Okay, great. Let's get your next past pick from October last year. Linde PLC, LIN on the NASDAQ, 483.36 at the time. US now at 418.29, so 13% downside, 12% total return downside. This is a gas and oil company.
It's Linde's an industrial gas company, global. It's an oligopoly, and they have operations around the world. And so they provide industrial gases, oxygen, and and these gases are used in many processes, whether it's chemicals, healthcare. Oxygen in the hospitals, they will deliver that. Hospitality, we have carbonated drinks. They're providing the chemicals for that. And electronics. So they're seeing growth in electronics, but the other businesses, and that's about 35% of their business, the other 65 tends to be more cyclical, like chemicals, mining. And, we've been in an industrial not depression, but industrial slowdown for the last few years. So they're feeling the impact of that on their operations. However, this company can still grow in an environment where GDP growth slows or even turns negative. But the valuation has shrunk. The company's still going to grow their earnings kind of mid-single digit. They have long-term contracts in a lot of their, depending on the different delivery method, but long-term contracts that are locked in. They benefit from their scale and density. They can usually get a price, a couple % on price, and then they will cut if demand slows. They're very effective in cutting back on costs, and so you get productivity improvements, and then they will buy back stock. So company can still grow mid-single digit, and they are under-earning right now. And I feel that this is a kind of a defensive industrial company. I would keep buying it here. We continue to like it.
Okay. Let's get to your next fast pick, Microsoft, MSFT on the NASDAQ, 418.78 US at the time, now up to 495.46, so 18% upside, 19% total return. Upside, Microsoft, one of the big Mag 7.
Yes.
I'm going to presume you've held on to the stock and will continue to do so.
Yeah, I do. We continue to own it. It's pulled back about 8 or 9% since the company reported a few weeks ago. So I think actually below 500, it's actually a very attractive entry point. We do think they're very well positioned going forward. When they announced their earnings, top line grew 23%. Asia, which is their cloud computing division, grew 40%. I think the company is very well positioned to continue growing there. Microsoft, once again, has upped their CapEx because they feel they're very strong demand for cloud computing services. And so, and then besides Asia, they have other operations like, their office tools, which is on a subscription basis, so very recurring in nature. And they're embedding AI in those functions as well.
Copilots
Exactly.
Yep.
So, and then they have their investment in OpenAI. So, so I think given this pullback, it's trading at about 30 times forward earnings probably. So not, cheap, but I think reasonable given their growth rate and their outlook.
Okay. That rounds out the past picks from last October. We'll be back to take more of your phone calls and emails in just a moment. Stay tuned. Welcome back. Thanks for joining us. Let's go to Robert on the line. He's in Burlington, Ontario. Hi, Robert.
Good afternoon. If I could just make a quick comment on Well Health, I've recommended it a couple of times recently. I went in this morning and twice and bought like ridiculous prices. So anybody holding it, just hang in there. Don't panic. Christine, IBM, same sort of thing. It was 125 when I started buying. Everybody said sell. Now it's around 300. I think it's going to 500. I think it's underappreciated, but I think with a little makeup and lipstick, it's a beautiful company. What do you think?
Okay. Well, I don't own IBM, but it's done well. I mean, I think a few years back they separated their mainframe business, and then so the mainframe is separate from their consulting side of the business, and so I think it's benefited from this uptake in AI. It's kind of participated in that, but this multiple has expanded. I think the last time I checked, it's probably trading at maybe at 18 or 19 times forward earnings. Before it was like kind of low double digits. So, so the market has recognized, I guess, the improved growth outlook. But I guess in that space, we talked about CGI earlier, and I've just decided to kind of stick with that in terms of having exposure in that general consulting space because of the valuation discount.
Okay. Let's move on to Bob, who's in Pickering, Ontario. Hi, Bob.
How are you doing?
Good.
Hi, Christine, one of my favorite advisors. Anyways, I've got a question about Brookfield BNN. They're down today, but what do you think? They're going to recoup or what?
Sorry, I missed which Brookfield.
Corp.
Corp, thank you.
Yeah.
Okay, go ahead.
Yeah, so Brookfield Corp is the parent company, and obviously they have all these subsidiaries that are publicly traded, whether it's infrastructure, renewables, Brookfield Asset Management, and Brookfield Business Partners, which is their private equity arm. And we do own the parent company. We continue to like it. It's very well positioned on a lot of trends in terms of renewables. They've got exposure to Cameco, to uranium, infrastructure is hard assets. A lot of their cash flows from these operating subsidiaries are, backed by hard assets under long-term contracts and inflation protected. So they're and very global. And then as well on the alternative asset management industry as a whole, that industry is growing, and Brookfield is participating in that. Typically their customers, their clients have been large institutions or sovereign wealth funds and pension funds. Now they're targeting high net worth individuals, private individuals. So that's kind of a somewhat new market for them. And a few years ago, they bought a partial interest in a company called Oaktree Capital, which is a credit company that was the founder is Howard Marks, based out of the United States. Very well respected, and they do credit, high yield credit. So a different kind of avenue for Brookfield because they didn't have a lot of exposure or expertise in that area. And then a few weeks ago, I think they announced that they're buying the balance of Oaktree Capital. And that's been a very nice growth avenue for the company as well because it's opened up a new market, a credit market for them. So I think the company's very well positioned. And on pullbacks, I think you're good to add to positions or initiate positions.
Do you think they'll get further into credit?
Well, they've got a very good platform with Oaktree, and they're very well respected in that space. So I think that's going to continue to be a growth area for the company.
Okay. Let's move on then to Raymond, who's calling from Regina today. Hi, Raymond.
Hi. Christine, I was wondering what you think of West Fraser Timber. Would you hold it or sell it?
Okay.
Okay. Thank you for the question.
Okay. Well, we don't own West Fraser Timber, and typically we've never really owned lumber stocks in recent years because it's very cyclical. And, we're seeing weak demand for lumber and timber, and companies are closing down plants.
Yeah,
and
tariffs
mills,
are
right?
hitting them hard.
Tariffs are hitting
yes.
them. So that's the risk. And so you look at the chart, right? Like they can make a lot of money when things are going the right way, but then prices collapse. There's overcapacity, prices tumble, and then companies have to shut down sawmills. So it's too cyclical for myself, and so I would not be buying it here.
Okay, would you hold it if you were already bought in? I mean, it's down, I'm looking at almost 14% in the last month.
Probably not. And once again, the problem with some of these stocks is that, it's come back a lot this year. So now you have tax loss season coming up. So that may aggravate the share price decline, I guess. So actually, I think in a non-registered account, maybe take the tax loss, and that'll, if you have gains to offset. But it's not really a sector that we're interested in long term.
Okay. Let's go to Rafi on the line then in Toronto with a question. Hi, Rafi.
Hi, Marilla. Thanks for taking my call. Hi, Christine. Nice to see you back. My portfolio and I miss your sage advice. Are there legitimate reasons to be skeptical about investing in a software company like Constellation Software? I understand they continue to grow through acquisitions irrespective of who's at the top. The CSU reports today. Is this not a screaming buy at the...
Okay, thank you for the question. Constellation Software is going through a couple of different changes, one with leadership and the other with questions about AI and the future of software. Where do you land on this?
Well, we've never owned Constellation Software, which maybe was a mistake historically because the stock has done very well. And I guess it is well managed. We know that Mark Leonard has stepped down, so there's a new CEO in place. But, you're right. I mean, the company historically has grown mainly through acquisition, M&A, versus organically. And usually when I buy a company, whether it's in technology, I want to see a balance. I want to see a good organic growth profile, meaning they can grow without having to buy, and then they can supplement with M&A. And so it was always much more M&A driven, and they've been very successful because they buy smaller software companies with different verticals, and they kind of let them run their own after, and so they've got all these different companies underneath, Constellation, and they're starting to spin out some of these companies, I guess, to try and surface value. Now, is that going to keep happening? I get the question about, some of these software companies that they own, like maybe AI is going to impact the demand for some of their products, which is happening to a lot of software companies right now. And they're also much larger than they were 10 years ago. So to grow through M&A means they have to look at larger transactions. And I think Mark Leonard, the founder and retired CEO, he had actually indicated that a couple of years ago that they would have to kind of broaden their universe of what they were looking for, which is a little different because they tended to do smaller ones that worked out very well. And so usually maybe there's more risk when you're doing larger transactions as well. So, we're still not looking to add it. I think there's other software companies that, maybe have more of a recurring revenue stream model like Microsoft and more visible growth without having to do M&A. And that's my preference.
Okay. Hope that helps you out, Rafi. We're going to take a quick break. We'll be back with more of your phone calls in just a moment. Stay tuned. Welcome back to Market Call. Let's go to Chad. He's on the line in Saskatoon with a question for Christine. Hi, Chad.
Hi, Marilla and Christine. My question for Christine today is on ARC Resources. As of today, it pulled back about 8.5%, being a natural gas play. And coming into winter seasons, I was just wondering if she believes this is a good buy at this point. I legged in a little bit more today, and I was just wondering if I should do more this afternoon. Okay, thank you. Bye.
ARC Resources has been a topic for different advisors. They like the natural gas space. They think it's going to take off eventually. But what's going on a day like today and lately?
Yeah, I'm not sure why it's pulled back that much today. I haven't checked the natural gas price. It could be a reaction to that. But the stock's done relatively well. You look at the chart, and so it could just be some profit taking. It is kind of the premier player for natural gas. So I guess if Chad wants exposure there, it's probably a good holding to have and buy it on pullbacks on days like this when there's a general pullback and perhaps, maybe movement in underlying commodity price. I'm not sure what, as I said before, if natural gas is down.
Yeah, I'm just hearing they cut their production forecast, which could be why we're seeing that drop today.
Yeah, and I don't know the reasoning, why. It could be temporary. I mean, it's difficult, to kind of like drilling wells and producing. Sometimes you have these problems, and usually that's the time to buy a high quality player is when they have kind of these, these unforeseen problems. But I haven't listened to their call or their press release. I'm not sure what the reasoning behind it, and I think that's the next step, and see how permanent it is. Is it just kind of one quarter and it's going to resume? Is it just some temporary problem?
Okay, so, and just another note for that. So National Bank lowered the price target to 30 from 33. So there are a couple of hits coming for that company, which is probably why it's pulling back today. Let's go to an email from Raj. He says, what's your opinion of Cargojet? Cargojet did just report as well. They did not do well. That line chart moving down. Would you invest? Have you ever invested in Cargojet?
I haven't, actually. And I don't think I would even now. In the transportation sector, we've kind of stayed with kind of the rails, which I'll talk about. It's one of my top picks later on. And I think Cargojet is being hit by, weak demand for deliveries because of tariffs, perhaps, and because of just a weakening general consumer on the retail side. So, this is an industry that's pretty capital intensive. So, when you have reduced volumes, it really hits the bottom line. So I'd rather stay away from this.
Are you surprised some of that hasn't worked back both in trucking and in the airspace, considering tariffs? We kind of know now sort of what we're dealing with, and certain things are not going to move across the border as much, vehicle, steel.
Yeah.
But all those other things that we've been used to having delivered should still be moving.
I mean, they are. And I think Marella, you're right that when the tariffs were initially announced, some companies probably kind of pre-ordered or pre-shipped, right? Because they didn't know what the outlook was going to be. So we've got holiday season coming in, but all those goods are probably already in the warehouses. And so you're not going to see them shipping more because they've already shipped. So maybe you're seeing a bit of a lull as well because goods were brought in ahead of time. And now there's more clarity going forward, perhaps, then maybe things will start to normalize somewhat.
Got it. Okay. Let's move on then to Chetan, who's in Toronto with a question. What's your question today?
Good afternoon, both of you. My question regarding the Visa. What is your long-term outlook? Is it a good entry point? Thank you. Have a good day.
Okay, thank you. We'll have a look at Visa right now. And it's been going sort of sideways for a little while.
Yeah.
Do you hold Visa or MasterCard, one of the credit cards?
Yes, we own Visa, and we've held that for a number of years. And we continue to like it. I think long-term it has a very positive outlook. It's all about, digital payments. There's still a part of the world where checks and cash are used. So there's still some growth in that area. But as we all know, like during COVID, big bump on, using digital payments because people were shopping remotely. And e-commerce, once again, is contributing to continued growth in digital payments because when you shop online, you're paying with a credit card or some, typically a credit card. And in terms of cross-border volume and travel, that's held up pretty well. We're seeing the high-end consumer continues to travel and buy. Stock market's been great, so those things are contributing. And yes, maybe the lower income households spending is a bit weaker, but they also found during COVID that transition to households using their credit or debit cards to buy everyday items, not just big ticket items. So it's
racking up the points.
Yeah, exactly. You go to a coffee shop sometimes, now you just pay a cap. So that's actually provides an underlying more maybe steady demand environment or volume environment. And as well, Visa as well as MasterCard, they're developing value-added services for companies, whether it's cybersecurity. And so it's not just transactional now. So that business has been growing to the point where I think it's about 30 or 40% of their top line. So that's also a growth area, which is probably more subscription-based as well. So we continue to like it. And on pullbacks like today, I think it's a good entry point.
Okay. That is all the time we have for your phone calls and your emails. Christine will share her new top picks when we come back. Stay tuned for that. Join us on Monday for Market Call. Gordon Reid on the show with us, President, CEO of Good Reid Investment Counsel. He will take your questions on U.S. equities. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Christine. Abbott Labs is where we begin, ABT, on the New York Stock Exchange. you have like similar stocks in the space, but tell me about Abbott Labs.
Yeah, so it's a diversified global healthcare player, 4 operating divisions: medical devices, diagnostics, established pharmaceuticals, which is essentially branded generics they sell to emerging countries, and then nutritionals. So the products in the nutritional space, the viewers will be familiar with them: Ensure, Simulac, those type of products. And so why we like Abbott, we've owned it for a number of years. They actually benefited quite a bit through COVID because they were making the testing kits. And to give you a size of the impact, Marilla, in 2022, they generated $8.4 billion in sales from COVID-related testing kits.
Wow.
And last year, it reduced down to $750 million. So they had a huge boost in their top and bottom line. The company used that to reinvest in their business and R&D to grow their pipeline. So they're very well positioned now going forward. They have a lot of product launches coming out. So we feel that they're kind of very well positioned to, this company typically can grow their top line high single digit and then their earnings double digit. So we think they're well set up to do that. The company also has increased its dividend for 53 consecutive years, so it gives you a yield just under 2%.
And is this a company that'll benefit from the aging demographic?
Yes, definitely.
Got it. Okay, let's get to your next pick, which is CN Rail, which you alluded to earlier today in the transportation sector. CNR on the TSX. Why do you like the rail over trucking, or we talked about cargo jet?
Yeah, well, CN Rail, I mean, as we know, I mean, they have, their networks are so embedded across, Canada and the United States. And so it's really hard to replicate that. And for CN in particular, the valuation on CN has dropped quite a bit. It's trading probably kind of lowest in the group and used to trade at a premium. And some of it is warranted because last year they had to reduce guidance a few times. There was a weaker economic environment, so volumes were not as strong as they anticipated. And then they had disruptions in terms of labor and port strikes. So that impacted CN more than some of the other rails. And so it was unusual for them to have to reduce guidance. The market doesn't like that. They got penalized. Now, coming into this year, they've reinvested in their network. They're actually spending a lot of capital spending to build up their network because they need more capacity. That's behind them now. So in its most recent quarter, which was about a week ago, the company indicated they're going to reduce their CapEx to a much more normalized level like the other rails, kind of mid-teens as a percentage of revenues. Theirs had been over 20%. So they feel that, they've got the capacity in place. They're levered for any volume pickup. They've reduced labor costs, so they laid off some people. So, and their operating ratio, which is kind of the expenses as a percentage of their revenues, is coming down. Their network is running well. So we feel they're well positioned. They maintain guidance in current environment. And going forward, with valuation at such a discount, any kind of pickup in volume will flow to the bottom line.
But do you feel there will be a pickup in volume? I guess that's my concern.
I think, you talked about the tariffs, and so that impacted in some of the commodities. But, we have more clarity on that now. And then with the recent announcements by the Canadian government, obviously with the budget, they want to promote investment. We'll have to see how much the execution behind that. But if they're successful in doing that, that should be beneficial for any transportation company because it means more goods to transport. And I think, back to my other question about rails having to grow. I mean, it is about taking share from trucking. So they have intermodal operations, and they have to make sure they're delivery on time and all that kind of those metrics. And so I think they are improving on those metrics. So there is room for growth.
Okay, let's get to your third pick, which is Otis Worldwide. Otis Worldwide is OTIS, and on the New York Stock Exchange, they do building systems, I guess, essentially.
Elevators and escalators is what
yes.
they do. Yeah. And they were spun off from United Technologies in 2019. So we had owned UTX back then, and we continue to own Otis when they spun this company off. So why Otis? The elevator industry is actually quite attractive because there's two parts of the elevators. There's the new equipment part, which is where you actually buy the elevator. Margins are pretty low, it's 5-6%. And there's the service part, which is when you typically buy the elevator, you have a service contract attached to that, which is a maintenance contract. And that's usually, 4 or 5 years in duration, very high margin. The margins on the service contract is about 25%, 24%.
Okay. Decent margin.
So a very service-driven type business. Otis, it's an oligopoly. Their competitors are Kone, Schindler, and ThyssenKrupp, I think. And those four have about 60% market share. And so for Otis, the new equipment side has been weak. China has been a very weak market. They were a very strong buyer of new equipment many years ago, but with their economy slowing and arguably the overbuild in property. But when the company was spun off, when I talked about getting that service contract, what they call the conversion or attach rate, in China, usually it's about 65%, meaning that when 65% of their customers that buy the new equipment will sign a service contract. In China, that was less than 40%. So they made a concerted effort to increase that to the point now it's over 50, and they're targeting 60%. So the service side is growing, and the install base is aging. Like 40% of the elevators out there are over 15 years. And that's important because once it reaches that point, you either have to modernize or replace. So we're entering that. So we think that the industry as a whole, including Otis, is well positioned to take advantage of that aging installed base because eventually they're going to have to replace it with new equipment.
All right. Sounds like good reasoning. Christine, we have to leave it there. Thank you for joining us today. Christine Poole at the table, and thank you for joining us today for Market Call. We'll see you back here again on Monday.